Hi everyone, I'm Rob Devlin, Head of Advice here at Tribeca Financial. We had the budget come out last night, so I wanted to give you a quick update on some of the key headlines that were in there. I think the really big one was the changes to the capital gains tax regime. We did expect it to mostly impact residential properties. As it turns out, it's going to apply more broadly to essentially all investment assets, so that includes shares, businesses, etc. Instead of having a 50% discount on your capital gain if you hold an asset for more than 12 months, you'll instead increase the cost base of the asset by inflation or CPI over that period. It's going to be more complicated to work out what your actual tax position is going to be, and something we're certainly going to need to factor into our planning, and it's going to impact a lot of people. Many of you will have already read this, but negative gearing moving forward is going to be phased out for existing properties. It will be retained for new builds, but for anyone buying after last night, an existing property, you'll no longer be able to negatively gear that property. I think one that is maybe a little bit more complex, and it's going to impact a lot of people, we believe, is the changes to minimum tax on trust distributions. There's all sorts of reasons you might have a trust. It could be estate planning or asset protection. It also can be to help manage your tax. So they're bringing the floor up there to 30%. So all trust distributions will be taxed at a minimum of 30%. Where we think that's going to have some serious consequences is people who run small businesses through family trusts, people who own investments in family trusts who are retired and don't have other income. And there's going to be a need to review those structures and make sure they still work for them. And it may be that those alternatives are now the better option. So definitely something to keep our eye on there because I think it's going to affect a lot of people. One other area that may not get as many headlines, but we know will affect a lot of people, is the changes to the private health rebates. So this is specifically for people above 65. Will be going up when these changes come through. So that's something to expect and keep an eye out for. There was a couple of tweaks to the marginal tax rate system as well. In short, over the next few years, the tax-free threshold for where you start paying tax, that's going to increase to effectively around $20,000. And then that first rate of tax will be reduced from 16% to 14% over the coming years, which will give everyone a small tax reduction by the time that's all flowed through in 2028. Another one I think worth noting is the changes to the fringe benefits tax exemptions on electric vehicles. To get the exemption in the next 18 months, they will be reducing the limit of the price of that car. That will come down to $75,000. And you'll still be able to claim the full fringe benefits tax exemption if the car you purchase is under $75,000. There's still time to act on that. I think one of the other key messages is there was no major changes around superannuation. The capital gain discount in superannuation still remains. So it's as ever an attractive place to invest your money. Our message would be, keep in mind, none of this has been legislated yet. Some of it I'm sure will flow through exactly as announced, but plenty of it will likely be tweaked. There'll be negotiations in Parliament, and we still need to see what the final laws are going to look like. There's some of our key messages. I hope that was of value to you. If you've got any questions at all, feel free to reach out and we'd be very happy to help.